Welcome to Deal Team 6, a podcast highlighting the stories and lessons from the M&A Battleground, featuring the team of TKO Miller. Each month, we deliver a mixture of stories from previous deals, updates on middle market activity, and guests who have seen it all. Now here's your host, Tammy Miller.
Hey, welcome everybody to this edition of the Deal Team 6 podcast. You might notice a different background today. A couple of new newsworthy items. One, that we're expanding our office space, and part of that expansion means that our podcast studio, our normal podcast studio, is under construction. So, rare glimpse into the TKO Miller office situation. You're in our whiskey room, which is a nice space that our colleagues get to relax in. These are the relaxing chairs.
Cigar room too, but don't tell the landlord.
Yeah, don't tell the landlord. So we're having our podcast in the whiskey/cigar room today, which is why the microphone is sitting on a log and we're sitting in these comfy chairs. You might notice some interesting ambient noise, but we're making it work. That's okay. So that's interesting. And we have an interesting topic today that I think is really important, and we see it a couple times when we're talking to some of our younger clients. You know, we work mostly with family and founder-held businesses, and I would put this squarely in the category of founder-held. Founding and starting a business is difficult, and a lot of time folks are bootstrapping capital, and it can be incredibly attractive when someone shows up at your front door with a pile of money, right? So that's the situation we're gonna talk about today. A couple of definition items. Let's talk about a strategic buyer, just sort of out of the box. Why don't you talk about what a strategic buyer is and what that means, just as part of context.
So the easiest way to think about a strategic buyer is that's basically someone that's in your industry. You can think competitor, someone who's doing something very similar to you. Maybe it's a takeoff from one of your businesses, but someone who's in your industry doing something, the same thing or something related to what you're doing. Might have similar customers, similar suppliers, but is related to you or your industry in some way.
Right. So the situation we're going to be talking about today is if you are a smaller business in a situation where there is a larger business that wants to make an investment in you. And by larger business, I mean significantly larger. So think of yourself as someone that maybe has a small business that makes a really fancy kind of tape, and 3M comes knocking at your door, and you've been financing, you've probably double mortgaged your house, you've sold one of your children, and 3M comes knocking at your door. Are you excited as the founder of that business?
Well, of course you're excited because 3M is tape.
Right, exactly.
3M is tape, and what could be better? Because you've been struggling with capital, you've been struggling with resources. Maybe you're making it in your garage, and you've just mortgaged your house to get to a bigger facility.
Right.
But it's always going to be a struggle, especially those early years.
Mm-hmm.
Sales would always be a struggle, and you see this larger, dominant player in your space that wants to be a part of your company. And you just think about all the good things short term, and what 3M in this case could do with that company, and you're ready to go.
Right. So why might a big company who has all the resources in the world, why do they bother making investments in little companies? Why do they do that?
Well, a lot of times, in this case, it would probably be for the technology.
Right.
Maybe they see something that they've been either thinking about or trying to get into, but they just haven't either thrown the resources at it or haven't been able to get it right. and they see someone who's done that, and they think, maybe I can pick up a couple years here and develop it quicker, get into this market quicker. They've got something, maybe it's patented, maybe it's got some intellectual property tied to it. Maybe I can get into it quicker by just buying this and then throwing some of my resources behind it to get into that market quicker.
Yeah, I think what people fail to recognize is that when you get to the size of, name any of the behemoth companies of 3M and J&J, of, Procter and Gamble, the time it takes to get to develop anything is enormous. The red tape, the meetings, it is impossible to do anything quickly in that kind of infrastructure, and the amount of money, the amount of time, and so to acquire technology can be the most cost-effective way to do R&D.
Yep.
And
Sort of like outsourced R&D.
right,
Yep.
exactly.
That's a good point.
So that is one of the reasons that they do that. And one of the things that many big companies have is and that most people don't know about is their own in-house venture capital funds. Some of them have VC funds, and so if a large company comes and says, we have our in-house incubator, our own in-house venture capital fund, don't be surprised if they start acting like a very professional investor.
Sure.
They have term sheets, they have, all of a sudden, it's not going to be, your friend that works at 3M, it's going to be a very professional investor. And you have to start thinking about someone that is a very professional investor in your very small company.
And the flip side of that is, even if they don't, they're likely, the size of companies we're talking about, they're likely to have an in-house M&A team that's going to be very professional. They're going to have done this a lot, certainly a lot more than you have, and probably a lot more than some of your advisors have. And so when they've got 100 under their belt and you've got maybe 0 or maybe 1, they're just going to be better at it, and they're going to know the traps and the tricks, and they're going to know what they're doing, and it's a situation you really need to be careful of.
Yeah. And so when they walk in and they make something that looks like a venture capital investment, that's pretty straightforward. That looks like an investment. But what are some ways that a big company might be making an investment in your company where it doesn't look exactly like an investment? And things I'm thinking of are a royalty arrangement,
Sure,
for example.
I mean, something like that, or a customer arrangement.
Yes.
I'm going to buy a certain amount. Maybe it starts out as just a customer arrangement. Maybe it grows into an exclusive customer arrangement because they're going to guarantee so much product a year, which takes some of the challenge off of your planning. That can be very slippery, though. Maybe they start asking for certain parts of the market then.
Mhm.
And again, all of these things are paths that some of these investors or bigger companies can go down that can be very slippery and very dangerous for the smaller company later in the transaction.
Right. I mean, some of the things that I've seen personally are companies that have come in that have asked for exclusivity in markets. I want all of the healthcare market or the oil and gas market. They've asked for most favored nation pricing. That's a very common one. So no matter what pricing you offer other customers, I always get the best pricing. So that's one that they asked for.
Yeah, I want to touch on that one because
Yeah.
we've in the past we've had customers that have touched on most favored nations,
Mhm.
and when you only have a handful of customers, that's fine. But when you have a big customer and you promise that, and then you have salespeople out there cutting deals, and depending on what rebates or special discounts, if that big customer that's got a most favored nations clause in their contract comes through and likely has audit rights, comes through and looks and finds that you sold something to another one of your customers and it was cheaper than what we sold it for. It can be a huge rebate or refund you owe someone. It's very dangerous provision.
Yeah, I don't think people recognize how dangerous that
Yeah.
can be. And another one I see sometimes is where they come in and unknowingly they take up a lot of your capacity, which might in the short term feel like a good thing, but can really be a constraint from a growth perspective. And I'm thinking of one customer in particular, I don't know if you remember this, where they had to hold open time
Yeah,
for
they
that customer.
Had to hold the line open.
They had to hold the line open
Yeah.
just in case this customer were to call.
Sure.
And do you remember how difficult that was from a planning and eventually from an income statement standpoint, a profitability issue?
Sure, because the times they didn't call, you would see
It was just
huge,
open.
huge swings in profitability and utilization of
Right.
equipment.
Right.
Yeah, it can show up and really strangle a business, but you know, you see the short-term benefit, and I'm gonna get all these sales and I'm gonna make some
Yeah.
short-term profit, and you're not thinking more broadly about what it's doing to the overall value of your business.
Right, right. I know that you have a example that you've run into lately that involved just, I'm pretty sure that was just a minority investment. And one of the things that I want to make sure that we talk about is the fact that, you know, a minority investment might feel like it still preserves the right of a business owner to sell their business later. And I know that many people think this. You know, don't worry, Tim and Tammy. I've only sold, name the percent, 10%, 15% to large customer X. I'm still going to run a process and sell my business the right way with an investment bank later. And then, you know, we shake our heads and you know, moan and groan because it really has a chilling effect on what their ability to run a real investment banking process is later. And I don't think people appreciate how much wind it takes out of their sails from a valuation standpoint later. And I always tell people it's like you've given that large customer a very low cost option on your business.
Yeah, a right of first refusal.
A right of first refusal, yes.
You've,
and they just look at me like, what are you talking about? But
I think sometimes the lack of sophistication, and it's no fault of the business owner, but they get so tied up with 5149.
yes.
You know, I've got 51 or I've got 80 and it's 80-20
Yeah, whatever
or
it is.
whatever it is, and they think I've got all the control. Well, you have certain rights, but you know that minority shareholder has certain rights as well. And one of the biggest, as you were touching on, one of the biggest challenges that poses is the perception to other buyers. Well, you've got 3M here in our example case. That's got 20% of, you know, the business or 10% of the business. They're going to get last look, or they're going to pull their business, or you know, some other chilling. You know, they know the company better than we do. Why aren't they buying it?
Or they have exclusivity in the oil and gas market, or yeah, I mean,
It's a myriad, and those are just a sales process to begin with is tough enough. You throw on these 4 or 5 other, you know, increasing hurdles, and sometimes every one of those hurdles just takes a shot at price as you go along and costs that business owner a lot of money.
the other problem, and I don't think people recognize this, is during this partnership that you've had with this buyer, who may very well be the best buyer for your business, is they've had this opportunity to live with you and in effect do a lot of diligence on your business that other people haven't. So they've seen the good, but also maybe some of the bad of your
Sure.
business. and so we don't have the opportunity to lay that out in in the way that we might if we were putting it in an offering memorandum.
We don't have the chance to pretty it up as best as we could.
Right. Or at least to position it in the same way for all buyers.
Right.
In this case, 3M has seen you, drunk and hungover, and we don't get to, and no one else has, but they've seen you at your very worst, and we don't get to, put some makeup on you and put you in front of the same way in front of everybody.
Yeah, I mean, almost in any case, any minority investor's almost always going to have a board seat or at least observation
Yes.
rates.
Right.
So you're going to see all the pluses and minuses. You're going to see management, the pluses and minuses. So you're going to know more than any other buyer.
Yeah.
And again, that's one of the reasons why a different buyer's going to go, why am I winning?
Yeah.
Why aren't?
Wait a minute.
What do they know that I don't?
Right.
And that's a chilling effect.
Yeah, if you can get them interested at all.
Yeah.
It's hard when someone else is in there. Okay, so the last question I have for you then is, how then, if you are a small business and a 3M or a Johnson & Johnson or a Procter & Gamble, how then do you make it work? You have a customer, a large customer. How do I structure it? Maybe not an investment, but a large customer relationship. How do I make it work?
Well, it's still tough because again, they're always going to be very good at this, and it's the biggest risk is it's going to be a creeping relationship. So you're going to have to be
Right.
careful at all times because even if it starts out, small,
Right.
each increasing order, you're always going to want to increase the volume with these key customers. You've got to, a good example would be, you've got to watch the volume that's dedicated just to them.
Right.
As your concentration grows, almost, without, no fault of your own, they become a much more important part of your business and have power over you whether you like it or not. Someone becomes a 30, 40, 50% customer of yours, all of a sudden they start calling the shots.
Right.
Because
Right.
they threaten to walk away and your business, is in serious jeopardy. So it's always difficult, and you have to be able to continue to, manage your business towards other big customers and other things. So it's never easy, but continued diligence and continued watching.
And I said,
What have you seen?
I said, try to stay away from giving away exclusive rights to things, wholesale market. Don't give away wholesale markets. Try to stay away from selling little pieces of your business. I mean, if you want to, because there is no such thing.
Right.
I mean, if you want to sell a small piece of your business to 3M, you really ought to be thinking about selling your entire business to 3M. Or, I mean, we're picking on 3M, but for no good reason. I mean, they're a fine buyer, but insert any large company there. But if you're thinking about selling any % of your business to a large company, you really ought to be thinking about selling your entire business to a large company, because in effect, you are chilling the whole process for your future sale. It is very difficult to get full value for your business once you've sold that minority stake.
I think it's tough to start parsing out pieces of your business.
Yes.
And when you start doing that, it may not be something you're interested in today. It may not be something that you can develop today, but it may be very valuable when you take the broader business to market. And sometimes business buyers, we're careful to make sure we describe all the elements of business, not just the ones that are very successful today, but the growth opportunities in a business. And sometimes buyers are buying some of those undeveloped opportunities because they know what they can do with them. And if you've given some of those away, it's obvious that you've cut out some of those buyers from your process.
Right, exactly. And I think, as you mentioned, even some of the things that might feel like they were not a big give at the time, the most favored nation pricing, that feels easy to business owners, but it has some pretty big consequences if you stumble, to try to avoid those as well. Having large blue chip customers is a positive during a sale. So
Sure.
don't not take them as customers, but certainly be careful about large concentrations, giving away exclusive rights to to markets and
That flip point that you make is important, because a lot of times when we sell smaller companies, they may have an inroads to a company that a buyer may want.
right.
We sell to Kmart, we sell to Menards.
You just dated
Sorry.
yourself.
Sorry. Yeah, don't know what Kmart, and Sears Roebuck and McKenna Rewards. I could name them all. We sell into Menards, or we sell into Home Depot, or
Yeah.
Lowe's, and do very well, with their buyers.
Right.
It can be a real plus. We have 90% of our sales with Lowe's or Menards. That might be not so much of a plus.
Yeah. And a lot of times those blue chip customers come with audits or specs or requirements that, if you can live up to those levels, mean that you're producing at a level far above your size in many cases. So that's good.
Yep.
It's a certain level of respect that comes with it.
Yep.
So pluses and minuses in many cases.
Just be careful.
Just be careful.
Thank you for joining us today. Make sure to visit our website at www.tkomiller.com, where you can subscribe to the show. While you're at it, please check out our seller resources page, where you will find frequently asked questions on mergers and acquisitions, family and founder-owned businesses, and a host of other interesting topics.